Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss our top 5 retirement income planning strategies. Specifically, we're going to chat about how to determine your optimal CPP start date, the importance of proper asset allocation, how to properly use pension income splitting with your spouse or common law partner, steps to take to minimize the up and downs in your portfolio, how to determine your retirement income withdrawal strategy, and lastly, a few action items for you to consider. Hello everyone, hope you are all well. A few weeks back, my wife and I took some time off and did some fishing at Blackstrap Lake, just south of Saskatoon. We went during the week, which was super nice. The boat launch was quiet, and so was the lake. We did pretty well, caught a few perch, a walleye, and a pike or two. Took the pike home and cooked up some tasty fish tacos that night. Now, if you like to fish, you may scoff at the idea of keeping a pike because of all the bones, but I highly recommend trying the 5 fillet method for deboning your pike. To be honest, it took a few attempts to get the process down, but it really does work like a dream. I'll leave a YouTube link in the description for all you outdoorsy types to have a look. All right, so back to the episode. Today, I'm going to unpack my top 5 retirement income planning strategies. There are many more strategies out there, so I tried to highlight the most common topics I come across with clients in my day-to-day. Each of these strategies warrants its own standalone episode. So in the future, I'll take the time to unpack each of these strategies and get a bit more granular. But for today, let's keep it high level and discuss these 5 retirement income planning strategies at a glance. Like I said, each of these will get its own episode in the future, so be sure to hit subscribe to make sure you don't miss out. All right, so first off is choosing your Canadian pension plan start date. This one is huge, as once you make the choice to start, there's no turning back. So you want to be sure you get this right the first time. If you take it before age 65, this amount will be reduced by a certain amount, and if you wait until after 65 to start your pension, it will actually be enhanced. I have spent countless hours building financial projections for clients to help answer this one question. The question is so commonplace that in 2021, I wrote a book specifically on how to maximize CPP and your other government pensions. So if you're listening, hoping for that silver bullet of an answer to your start date question, I'm sorry to disappoint. The commonality of all these client scenarios I've worked through is, well, that they're all actually unique to that family's personal situation. There is no one-size-fits-all solution when it comes to this, so I would suggest the first place to start is to ask yourself a few questions. That way, you'll gain more sense of what may make sense for you. Do you plan to continue to work past age 60? If so, it may make sense to wait. How's your health? If you have a shortened life expectancy, you may want to consider starting early, as once you pass away, your benefit stops. That is, unless you have a spouse or common law partner, then the survivor benefit would kick in. Do you have investments to provide an income in your early 60s? If you do have the financial means to create your own income, delaying CPP will ensure a higher fixed monthly income in the future. Is your spouse continuing to work? If their income is able to sustain your family's lifestyle, it may be wise to delay CPP to enhance the benefit. In extremely general terms, if you have the ability to delay CPP, you will help to ensure a fixed increase to your monthly income for life. Start to drill down on your own personal situation by asking yourself these questions to start the process. Next, you'll want to work with a certified financial planner who will be able to consider your personal situation to project a few potential scenarios in the future. These scenarios will include your withdrawal plan, CPP crossover date, tax planning, and more. Okay, so the next retirement income strategy is to ensure you have proper investment asset allocation. In plain English, asset allocation describes what percentage of stocks, bonds, alternative investments, and cash you have made up in your portfolio. This can then be broken down further by determining your stock style exposure, stock sectors, bond maturities, and more. Without getting into the financial jargon anymore, let's boil this down to what it means to you. In my opinion, proper asset allocation during retirement should focus on two core areas. First, you have the proper mix of assets that are suitable for your risk tolerance, time horizon, and investment objective. These assets should provide you a reasonable, risk-adjusted rate of return that will reduce volatility and mitigate the emotional impact of market drawdowns. Second, your asset allocation is factored in your income needs and is positioned in a way that it can provide 2 to 3 years of income not impacted by changes in the market. This is often referred to as bucketing or a cash wedge. I like to call this your war chest of short-term liquid investments. In English, proper asset allocation will help you sleep at night. No joke, just think about it. If you're on the golf course and you happen to check some news headlines at the turn, these news headlines are sure to impact the markets, so you may ask yourself, how is this going to impact me and my family? Going back to my first point, because your portfolio is structured in a way to provide a comfortable, risk-adjusted rate of return, you are confident your negative investment exposure is mitigated. This is where the use of some alternative investments can really start to show their value. More on these kinds of investments in a minute. Second, also know that even if your investments do get drawn down a bit, you can turn off the tap from taking withdrawals from these investments and shift income withdrawals to assets that were not impacted, i.e., your war chest of short-term liquid investments. Investing, although necessary, can be extremely stressful, especially if you do not have these two core areas covered off. Ensuring you do will help to take the emotional strain out of the inevitable market ups and market downs. Alright, so the third retirement income planning strategy is proper use of pension income splitting. In short, pension income splitting involves notionally splitting your pension income with your spouse to reduce your household overall tax bill. When I say notionally, I do mean you aren't actually transferring money to your spouse directly. The pension income splitting takes place when you file your taxes and you tell the government to attribute some of that income to your spouse, who presumably is in a lower tax bracket. And that is the whole purpose of this strategy, to reduce your household's total tax. Now, only certain accounts and pensions can be split, and there is a difference based on whether you are younger than age 65 or older than age 65. So there is some nuance here on what you can split. Think of it this way. Assume one spouse has a pension income that is eligible to be split of $60,000, while the other has an income of $30,000. Before splitting income, their household tax would be approximately $16,000 in Saskatchewan. If we assume they split the income evenly so they each pay tax on $45,000, their new household tax would be $15,000, a $1,000 reduction in tax based on this extremely simple example. Pension income splitting becomes even more important when one of the spouses' incomes gets near the OAS recovery tax limit of approximately $87,000 in 2023. A spouse can avoid the OAS clawback, which is an effective 15% increase in tax by simply splitting eligible income back to the lower income spouse. I would encourage you to have a look at your previous tax return to see if there is some opportunity to save some tax using this strategy. At our firm, we prioritize this kind of tax planning with clients each and every year. We like to focus these tax planning meetings at the last quarter of the year so we can get a full sense of the income for the year and make a plan to potentially access additional taxable income to optimize a client's situation and minimize the lingering tax liability of those registered accounts. If this is something you think you could benefit from, I encourage you to connect with our team. All right, so the next retirement income strategy is to minimize the ups and downs in your portfolio. Now, admittedly, this is a bit of an extension of my asset allocation strategy, but for good reason. Reducing those ups and downs will help to alleviate some emotional stress, so it's worth ensuring you have a strategy to do so. Now, in advisor speak, you will often hear people like me say words like standard deviation, risk, volatility, etc. But the simplest way to think about it is like a roller coaster. A steep roller coaster with big ups and downs may be fun when you're young, but as you get older, you may find yourself akin to something a little less aggressive. This analogy, applied to your investments, works pretty well. When you're young, you can take a bit more risk in your investments because A, you have the time ahead of you, and B, you're not withdrawing your investments to live off of. When you're older, you don't have the time for your investments to recover from volatility as you are withdrawing out of your investments to live. This is why risk-adjusted, low volatility investments are crucial to your retirement plan. Let's take an example where you have two investment portfolios. Both portfolios start at 0% return on January 1st, and on December 31st, they both ended positive with a 5% rate of return. Now, if you don't have to sell any of the investment throughout the year, whichever investment you choose shouldn't make that much of a difference, especially if we're not factoring in tax. However, now let's say you need to withdraw money on a monthly basis. The first portfolio is like the roller coaster with lots of steep ups and downs, while the second portfolio is slow, steady, boring, and doesn't fluctuate much throughout the year. At the end of the year, the retiree on the boring ride will likely be in a much better position because as they were withdrawing their income on a monthly basis, there weren't these huge swings that would force them to sell more of their investment to get the same amount of monthly cash in their bank account. So how do you do this, you may ask? Well, this is where adding alternative investments such as private real estate, private credit, and private equity can help lower the overall ups and downs in your retirement portfolio. This is especially important in accounts you use to create your monthly income, things like RIFs, PRIFs, and non-registered accounts. I'm sure you have questions about these alternatives I'm discussing, and I will be discussing them along with other strategies discussed today in later podcasts. But today, I'll direct you to our website, www.fundamentalwealth.ca, to learn more about this investment style. Okay, and the last strategy I will discuss is how to structure your retirement income withdrawals, often referred to as your withdrawal hierarchy. First, this strategy involves looking at all your sources of income in retirement, things like CPP, OAS, work pensions, PRIFs, TFSAs, non-registered accounts, and more. Once you have all of your current and future incomes lined up, you'll want to look at these through your tax lens. Here are some things to think about. First, what tax bracket are you in, and how will it change over time? Second, how will things like pension income splitting and other tax credits impact your household tax? Third, what is the looming tax bill for your beneficiaries? As with the CPP decision, which spills over into the withdrawal strategy, there is no one-size-fits-all solution. There is a balance between deferring tax now to minimize your taxes and maximize your government benefits, while also being aware of the potential for a pending tax bomb at last death. What's a tax bomb, you may ask? Well, if you and your spouse both have large RIF, RRSP, or PRIF accounts, at the passing of the last spouse, these would be considered 100% taxable to your estate. So for many of you out there who have hundreds of thousands, if not millions of dollars in these types of registered plans, there could be upwards of a 50% tax on these assets that remain in your estate. This is where a balanced, well thought out withdrawal order can help ensure you live a worry-free retirement, minimize your tax today, and to your final estate. All right, well, that's all for today. Let's jump into a few action items from today's episode. First, if you are within 10 years of retirement and want to make an income plan, your first step is to reach out to My Service Canada to request a CPP estimate. This will help to lay the foundation upon which you will build your retirement income withdrawal plan and help narrow down that CPP start date for you and your spouse. Second, seek some professional advice if you're not comfortable making a plan yourself. The strategies I've outlined in this podcast represent only a fraction of the tax, investment, and retirement strategies available to Canadians. I encourage you to work with a certified financial planner who is able to consolidate all these complexities to build your retirement plan, not just an investment plan. Third, enjoy the rest of your summer. My wife and son and I are headed to the lake this coming weekend to soak in those last few bit of rays before they're all gone. I hope you and your family can enjoy some time together, doing whatever it is that makes you happy. For all the links and resources discussed, check out the show notes or visit retiringcanada.ca. Be sure to sign up for my weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.